Welcome to Futures Now. I'm Jackie DeAngelis. We're coming to you live from the commodity desk at CNBC Global Headquarters. Here's what's coming up on the show. All eyes on the Fed as its two-day meeting gets underway. But Richard Bernstein's Joe Zeidel is going to give us his Fed playbook. Plus, crude climbing back above $50 a barrel today. And one of our traders is going to tell you where it's headed next. But let's start with the markets. The Dow hitting a record high with the S&P and the Nasdaq sitting just below their all-time highs as well. Let's bring in Jim Uriel and Brian Stutland, your traders today. Jim, let's start with you. What do you make of today's moves? Market just wants to go higher.
I'm still a bull. I'm less confident of a bull. I do think the Fed's going to talk somewhat dovish tomorrow because in the back of my head, I believe that they can't really tighten aggressively, or at least say that they're going to, until they can ascertain what the economic ramifications were of these two hurricanes. So I think right now, even though they might talk like they're still going to hike this year, I'm hoping that they're going to do it in a fairly rapid and kind of dovish bubble wrap, so to speak.
Brian, what are your thoughts? Is this basically, does it end up being a non-event?
Well, I think to some degree it will, because I think it'll be a little bit of wait and see until we get to the end of the year. But I think when you take a look at the market structure and the environment, with volatility, the VIX around 10 here, we're talking about no volatility, no fear in the marketplace. Korea can shoot off missiles and people don't care. The market still pushes higher. And I think the Fed's got to look at that and say, wait a second, this might be the time. If we're ever going to start to move rates higher, now is the time. We've printed over $2 trillion in the M2 money supply since 2008. And now we're starting to see a little bit of tick up in prices on the commodities side. We're not seeing wage growth yet, but I think they have to say, listen, the market structure can handle a rate hike right now. Why not take advantage of it?
All right. Well, the stock market's latest string of all-time highs could be giving investors a false sense of security. Market watcher Mark Faber, often hailed as the original Dr. Doom, is not backing down from his correction warning. Mark joins us live on the phone. He's the editor and publisher of the Gloom, Boom, and Doom Report newsletter. Mark, great to have you.
Thank you for having me.
Give us your updated view on the markets. As I mentioned at the top of the show, the market continues to climb higher. What's your stance right now?
Well, basically, my view has been that, the market may go higher, but a correction is long overdue, and that if the U.S. market continues to go higher, other markets are more attractive. I'm just looking here. Italy this year to date, is up 32%. And in Asia, we have many markets that are up between 20 and 30%, including, surprise, surprise, South Korea is up 27% in dollar terms. So then less worried about war than maybe some portfolio managers are in the U.S. or international observers. And maybe they didn't take the words of Mr. Trump terribly seriously.
Mark, are you still looking for a correction here in the United States in the range of 40% or so?
Yes, I think a lot of stocks have actually gone down by 40%. Some have gone to zero because in the retailing space we have a lot of bankruptcies. So, I think the markets are very high. The bond markets around the world are very high, very stretched, especially in Europe. They're completely artificial, as they are in Japan. The dollar was way overbought at the turn of the year. Now it's slightly oversold. Don't forget that in euros, the U.S. stock market is actually down this year. It's not up. So the dollar weakness has led to also stocks in the U.S. moving up. I think the dollar may rebound, but over the next 2 to 5 years, I would look for a much, much weaker dollar.
Jim Uriel.
Mark, we keep talking about a tax plan that's going to change corporate taxes to 15% and limit new regulations, get rid of some old regulations. If a tax plan comes in that really hits 15%, and I'm saying if it does that change the way you think too? Aren't all those corporations that you think are overvalued become a lot less overvalued in that situation?
Well, I think someone would have to pay for a corporate tax rate of 15%. And don't forget, in the U.S., what is the stated tax rate of corporation and what is the effective tax rate are quite different things. In the U.S., the effective tax rate for the corporate sector is about 21%. I don't think that this will change the needle or move the needle very much. But
Okay,
I think
Mark,
what would move the needle is, say, if the U.S. introduced basic income. And I think in 2020, you will see that this will be a topic of discussion during the elections, the basic income, universal basic income. So a lot of things will still happen.
Hold it. A universal basic income. Are you saying that would be a positive thing? You're a proponent of universal basic income?
Not the way it will be implemented, but in principle, I'm not completely opposed to it, provided the welfare state in its present existence is dismantled. But what will happen is they will introduce at some point universal basic income and maintain the welfare state, which will be extremely negative, certainly for the dollar. So I'd say...
That's what I was just about to say. That sounds like a firestorm for the dollar. If the dollar breaks below this 90 level and you think the dollar's going weaker, where do you think the dollar could go if we implemented those things?
Well, easily within the next 12 months, down another 10%. But as I said, right now the speculators are heavily short the dollar, and the commercials have actually moved to a long position. So I think that the dollar rebound is likely, especially against the yen. And talking about the markets, one market that has lagged behind just about everything is the Japanese stock market. And it's just broken out on the upside recently. And I think in the last few months of this year, we could get a big move in Japanese stocks on the upside.
Brian Stetlin?
Yeah, Mark. So one other thing, just to touch back on the stock market and your prediction of a major correction here of 30 or 40%. If you took the 10 lowest volatile years in the S&P since the Great Depression, every one of those had double-digit year-over-year returns. We're getting extremely low volatility. What is going to be this big event that is going to cause this decoupling in liquidity where you're going to get a 30 or 40% sell-off in the market? Because I just don't see that right now.
Yes, you're right. You don't see it, and I don't see it, and nobody sees it. That's why people keep on buying stocks. And yet, something will happen one day. I think it may very well come from a credit event, or it may come from the disclosure of a major fraud, or it may come because interest rates start to go up, although central banks remain on the dovish side. There are many events that can trigger, or many small events that can trigger a decline. I mean, in 2009, when stocks bottomed out, I can tell you that not many people saw why stocks would go up. And now it's the opposite. The sky is clear. Corporate profits have been expanding. They're good. Interest rates are low. But valuations are very high. That we have to see. Hardly anywhere in the world they are low, really low valuations.
Mark?
There are some exceptions, but in general, stocks and bonds are fully priced.
Mark, let me ask you, if there was one thing that you could buy right now at this moment, what would it be?
Well, I think relative to everything else, and it's moved into a correction period, I think precious metals are not terribly expensive. I think agricultural commodities are inexpensive. I think emerging markets, some of them have performed superbly, like Mexico is up 30% this year. Turkey is up 30%. Poland 40%, and so forth. But by and large, there is better value in emerging markets than in the U.S., except if the S&P drops 20%, everything will go down, except maybe precious metals and commodities.
Okay. Mark, great to have you on the show. Sorry?
Energy stocks are reasonably priced.
Okay. Great to have you. Thank you for sharing your point of view. And, of course, we'll have you back again soon.
Thank you very much. Bye-bye.
Bye.
Thank you.
Jim, let's get straight to it. You're trading the market for me after that interview. I mean, he always says he thinks the market's going down. You don't.
Right, and he always ends up depressing me. And there's things I don't disagree with that he says, but in the short term, I'm still a bull, as I said before. If the market trades 25.06, last I looked, that was just about a half tick above where we're trading right now. To me, that's an indication of short-term momentum is still intact. I think that's a spot to get in with a target of 25.22 on the upside. A trade back below 24.95 is where I'd wipe myself out.
Brian, reaction?
Yeah, we haven't seen that increase in volatility in this marketplace. We still see it declining, contracting. There is no fear right now. The momentum still is to the upside. I love this trade. I think the market continues to go higher.
Okay, let's get the risk reward on this one. Jim is buying the S&P at 25.06. He's targeting a move to 25.22. Each point in the trade is worth $50, so he's risking $550 to make $800. Okay, moving on. Speaking of the Fed meeting, let's bring in Joe Zeidel. He's a portfolio strategist at Richard Bernstein Advisors. Joe, let me ask for your expectations on what you think we're going to see tomorrow.
I think tomorrow's probably going to be pretty quiet. We're not expecting much from the Fed at all. I think toward the end of the year is when the odds of a Fed hike are going to pick up, and we certainly do expect that they will be hiking toward the end of the year. But this week, not much from the Fed in our view.
Okay, you're bullish on equities right now?
We are. We think equities are going to continue higher, and we think at year end, the leadership is going to be number one, emerging markets, and number two, the U.S.
In terms of the United States, any sectors, anything you're watching specifically that you think will be an outperformer?
Yeah, we think the cyclicals are really going to come on strong from now to the end of the year. And the short story on the cyclicals, that would be things like tech, financials, consumer discretionary, as well as materials and industrials. The thing that they all have in common is they're very sensitive to the earnings cycle. And I think that the big thing that investors have missed, it's kind of the most obvious thing that has been in front of most people, but they're not talking about, is this earnings reflation. Right. You know, I think if you talk to investors and you listen to the narrative, it's all about, one macro risk point to another, yet the markets climb higher. And people are asking, how can this be? Well, the simple answer is we are seeing earnings reflate, not only here in the U.S., but all around the world in a coordinated fashion in a way that we hadn't seen since the days prior to the credit bubble. So the playbook will tell you that when earnings are reflating, you want to own cyclicals, companies that are most sensitive to changes in that profit cycle. And so in the U.S., that is the tech, the financials, materials, consumer discretionaries, et cetera. So we think they're going to lead.
Joe, back to the Fed for 1 second. Sometimes we don't always have to see a move, but just the language from the Fed can move the market. Do you expect to see that?
Well, their language all along has been, kind of twofold. Number one, preparing us for the tapering, and then number two, for higher rates. And I think what the risk for investors is that they don't believe the Fed. If you look at fixed income holdings, whether it's portfolio managers or flows into bond funds and bond ETFs, what you're finding is that investors are disregarding the Fed's warnings and they're extending duration, right? Most investors have thrown in the towel and have simply said, well, rates are going to be lower for longer. And I think those investors are the ones that are going to experience the most pain, because it's clear that the Fed wants to hike. They want to continue hiking throughout 2018, and the data supports it. Right? All around the world, we're seeing growth accelerate. We're seeing the beginning of inflation. All signs point to higher rates, but when you look at investor positioning, they're going the exact opposite direction.
Jim has a question.
Do you think that the earnings reflation is, first of all, is that a function of a better macroeconomic picture? And if you have to pick the single biggest driver of the broad market, not just the internals, would it be a rate picture, something from Washington, earnings reflation, the weak dollar? Where do you think is the most important thing?
Well, I'll start with the second point first, right, which is the most important driver. In a word, it is earnings, right? If you want to value a security at its most basic level, it's not about geopolitical risk. It's not about China GDP or Trump tweets. If you want to value a security at its most basic level, it comes down to how much is a company earning, number one, and number two, what's the interest rate environment like? So all around the world, we're seeing profits reflate. And I think that speaks to the broader market, not necessarily just that sector leadership, right? We saw in the second quarter, S&P earnings up almost 20% on a year-over-year basis. And in the third quarter, the quarter we're in right now, we think when companies report in the U.S., we think S&P earnings will be up around 30% on a year-over-year basis. That's broad earnings strength, and that's going to drive the markets. Washington and all that other stuff is just going to end up, in the end, it's just noise.
Brian has a question as well.
Well, I just want to touch on this earnings and the reflation into the earnings picture here. How much of the earnings, though, is really due to corporate buyback driving prices higher with this low interest rate environment? One thing that scares me is rates tick higher. What happens to the corporate buyback program? How much will that affect the earnings picture that you're talking about?
Yeah, it's a great question. And the data that we're seeing now is indicating that those buybacks are slowing down. The pace of buybacks is slowing down, yet markets are continuing to go up. So when you look at the drivers to this bull market, clearly there's been buybacks. Clearly there's been a lot of M&A activity, companies being taken private, et cetera. That's reduced the amount of stock outstanding. But don't forget, the bigger picture is leading economic indicators all around the world are improving. Inflation expectations all around the world have troughed and are starting to rise. We're seeing growth in a coordinated fashion as well. All those macro data points are pretty equity bullish. And what they argue for is the cyclicals, the higher beta, kind of that just exposure to the markets.
Joe, great to see you again. Thank you so much. We'll talk to you again soon. Brian, so we took a perspective from a bear first, a bull second. What's the trade on this?
Well, I think Joe looks at the macro picture, and I think you want to be short the 10-year note here when you're looking at this. I'm looking to sell the December future 126, looking for it to trade down to 125.10 with the stop at 126.16. The reason being here, look if we're getting this good macro growth picture that Joe was talking about, then it's time. The environment is calling for it's time to raise rates. It's time to get that back into the yield curve a little bit higher. That will continue to get the growth that we need out of the financials, which should then essentially push the market higher. So I think it's time to do that. I think you'll see rates tick up. The failure to go below 220 on the 10-year and stay below there and tick back up, I think is an indicator that we may push to 2.5%.
Two things. First of all, we should always schedule Joe after Mark Farber because he did the impossible and he put me more into a good mood than Mark Farber taking that away. Right. So I thank him for that. Secondly, I don't disagree with Brian's fundamental analysis. The reason I don't jump on board on this is that the technicals still show me something a little bit different. For this year, yields have been headed lower. The last week has been the aberration that's knocked him up to 2.23. I got to see a settle above 2.3 before I'm with him on this trade. So I think the risks are the other way right now.
Okay, well, we're going to get the risk reward on this trade. Brian is selling the 10-year note at 126 even. He's targeting a move to 125.10. Each tick in this trade is worth 31.25, so he's risking 500 to make a little bit more than 600. All right, let's end the show with crude oil climbing back to $50 a barrel. Jim, how are you trading this move?
I'm looking at the November contract here. If it trades about 20 cents higher than where it is right now, 50.05, I think it's a spot to get long there with a target of 50.80 on the upside. Stop placed back below 49.55. Now, this trade is interesting, and on Twitter, we might be modifying this. If we get it to run, we might be removing that take profit because above, let's say, 50.90, it looks like a breakout on a bigger picture. So I actually think, we spent a lot of time in a trend channel that seems to be broken now, and a move above yesterday's high would confirm that for sure.
Brian, if the dollar continues to weaken, the crude trade will probably go up, right?
Right, yeah. I mean, I had a short dollar trade last week. I'm looking actually probably to close that. So I don't know how much more lower the dollar can go, especially if the Fed makes some indication and we get rates moving higher. But having said that, it does look like if you're a momentum trader in the crude trade, it looks like we are shifting higher. I like that Uriel points out if we trade maybe a little bit higher at that 50-80 level where that target is, we could take a little higher than that. However, in general, my just macro view on oil is above 52, 53 area. That's where you're going to see the U.S. shale producers really kick in their supplies, and I think it'll be difficult to trade much higher than that level.
One thing we should mention, Jackie, about the relationship between crude and the dollar, from that move from 105 down to 91, it's really decoupled. Crude has yawned at that dollar weakness.
So?
I do think it would change. From what? From like 46, right? I mean, there was OPEC leaned in a little bit too. There was, remember we started talking about demand. I mean, there was other things involved too. What I was going to say is if we break below 91.90 level, I think they go right back together, and I think that could push crude higher.
Okay, final question for you. When we look at the crude trade, there's resistance on the charts, right? Around 51. What does it take to get over that?
I guess maybe just a comment from, Iraq talked about OPEC reducing production again. There was actually real evidence that they were adhering to the production cuts last week. I guess something like that could push it over.
Okay. Let's go ahead and get the risk reward on the crude trade, guys. Jim is buying crude oil at $50.05. He's targeting a move to $50.80. Each dollar in this trade is worth 1,000, so he's risking 500 to make just about 750. All right, that's going to do it for Futures Now. I'm Jackie DeAngelis. My thanks to Jim and Brian in Chicago. Meantime, for you, if you missed anything, head back to the website, futuresnow.cnbc.com. Everything can be found there on demand. Meantime, for the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our newsletter at cnbc.com/Futures Now email. You can find the link to that and real-time trade updates on our Twitter account. The handle there is @CNBC Futures Now. We're going to see you, meantime, for our next live broadcast Thursday, 1 p.m. Eastern, right here, futuresnow.cnbc.com. See you then.